what's really fun is if you look at the Google network revenues, so the off-site Google stuff, the ads they run, historically a big chunk of Google's ad business, it's now just $600 million more in the last quarter than YouTube. So YouTube is about to surpass this critical old piece of Google revenue. But the YouTube gains were very impressive. But I'm curious what you made of the Google Cloud changes, because revenue did good, losses declined. I was pretty bullish about Google Cloud, and I don't know how you...
I think that they hit a key milestone, which was the cost of providing the service was less than the revenue the service brought in. I think they're still investing in it, but it's really hard to displace Amazon Web Services because Amazon has just got this relentless march towards how little margin they can have. Now, we don't have insight into each of the product lines at Amazon, but the scale of that business is crazy. But Google's cloud is super important for them to win as well, because if Amazon just has the biggest cloud in the world and Azure and Google Cloud fall too far behind, you
don't want a monopoly in public clouds. Here's a question for you, Jason, because you talk to more startup founders than I do, which is saying something. I'm hearing tweets and I'm hearing some complaints about AWS pricing from startups and maybe even some growth stage founders. People are just a little bit dismayed at how much AWS can wind up costing them. Is that going to help Azure and Google Cloud, or is that just complaints and it's not going to change much?
I think this is ride-sharing drivers complaining about getting paid, where it's never going to be enough. Everybody always wants a raise. So even when it's a double the minimum wage in the country, or it's 15, or it's 25, or they give minimums, people are always going to ask for more. And in this case, they're always going to ask for a smaller cloud bill. They throw, they're going to be like, this is too much. And if your startup grows, but they're not, this generation is not comparing their cloud computing costs to buying servers and racking them.
Yeah. And
just 20 years ago, there was a line item when you were raising your $3 million, seed or Series A, your $3 million Series A, 500,000 in servers and co-location facilities. And when I did Mahalo, we racked servers. And then at a certain point, we were like, the cloud, on the cloud, we had so much traffic that the cloud charged based on the amount of traffic you used. And when you have your own fiber line, you don't get charged for usage.
No.
And so all of those kind of things that are now competing with each other are going to ultimately drive this down. So I think it's much ado about nothing. And it actually gives Azure and Google Cloud, IBM, and other people's clouds the ability to compete. It's a great entry there. The other thing that's going to be interesting is, I don't know if you know about serverless, but there's this concept of you can build these little objects that run on the internet. Mm-hmm. And when somebody goes to hit a website, it fires it up, they run the execution, and then it shuts itself back down.
Yeah.
And so this can cut down, for some tasks in computing, 90%. So with software, you're going to keep seeing the software race down the utilization on the network, which then games the cloud. And the same thing with storage and other things getting cheaper. So,
well, the growth of usage of these public clouds is crazy. Google Cloud grew, I think, 54% year over year in Q2. Azure was 51%, so very close there. I think AWS was, I couldn't find the number, I was just looking for it. I think it was 37%. But I think about how much total spend we're talking about going to the public cloud just over the last 12 months in Q2. It's billions and billions of dollars. And thank you, VCs, for financing all the startups that are currently living off of it, because it's going great for the majors.
It definitely has changed everything in terms of the funding of startups. You literally took out 20%, 30% of the cost, and the time would have burned months of setup and runway. So really, you could have as much as a third or more of your startup's cost being the setting up of your office space and your cloud. You start looking at that and you're like, wow, you can just put that towards developers, or you can fund many more projects. A $250K check with a 2-developer startup can last them for 2 years.
So this just came up. I was talking to a startup actually here in Providence. There are some, proud to report, in my new adopted
There'll
hometown.
There'll be more.
Yeah, actually, that's what this founder told me. He's like, even in the floor of the building, we have a little office, and there's 2 more that are venture backed. I was like, okay, good news. But I asked him how long his $2 million seed round was going to get his company. I'm like, how much runway is this? And he didn't give me an answer in months. He said 20 to 25 product cycles. And I was like, that's the coolest metric I've ever heard someone bring up.
Probably 2-week sprint or something, 3-week sprint. Yeah.
Who knows? But I mean, like, that to me shows that they're not thinking about just running out of money. They're thinking about where they're going to get to in terms of what they're building. And if I was an investor, and I'm not, I think that would jazz me, because it seems like playing offense versus defense.
It is pretty amazing when the clock ticking down is not making your decision making, delighting customers is. And this is why when we syndicate a deal to the syndicate.com, which is like our previously was on AngelList and now we do it there.
Yeah.
We specifically, we will only syndicate you if you have a minimum of 12 months of runway, but we're looking more for 18 to 24 months. And the reason we do that is we tell them, we want you heads down thinking about the customer for at least a year, hopefully 18 months. So you don't have to pop your head back up and raise money. Now, of course, in this market, we literally had to change our accelerator schedule. I'll give you some numbers on this.
Sure.
We have over 300, I've invested in 300 companies in the last decade. I'm not sure how many of them are exactly active, but let's say 2 out of 3. So maybe 225 are still effective. We have 65 companies currently raising money or in the process of closing.
Out of the 225.
Out of the 225, 1 in 3, basically. And there were people who are closing before that and people who are thinking about raising money. But having that many in process, I've never seen. Yeah. And it has broken our internal systems because when a fundraising happens, you go to your existing investor, you have to get them to sign off on it, read the documents, agree, and then decide do they want to take their pro rata. With 65, that means every business day, 20 business days a month, I've got to be making 3 or 4 decisions a day and going over 3 or 4 sets of documents. The lawyers in our industry are now saying like, we need 4 days to turn around documents. We need 5 days to turn around documents. It used to be like, we can turn around documents in 2 days. No problem. Just give us 2 days, maybe 3. And now it's like, give us a week. We got just wait. I've never seen this level of activity.
Yeah, you think founders are doing well with ample secondary in the markets. Look at their lawyers, because the lawyers are doing fantastically right now because everyone needs them right about now at the same time, which means they have enormous leverage. Great place.
And attorneys are not getting a summer break, and a lot of VCs are not getting a summer break. I'm supposed to be going on vacation, and I'm scared to death to go on vacation because I'm just like, what's going to happen with all these deals? And we're basically, we came up with a term that my new term of art with founders is standing pat, which is the term in draw poker. When you say, oh, I want 2 cards, I'll take 3, I'll take 2. Mm-hmm. When you do draw poker, like the old cowboy poker, not hold'em, you would say, I'll take 2 cards. You give 2 cards, they give you 2 new cards. Standing pat is I don't need any new cards. So
right, I'm good.
We're just like, we're standing pat, we're good. We're not adding to our position. We're not going to lead this round. We're just going to stand pat. And I've had to tell companies that we may have actually participated in or led, like, we're going to stand pat because we just can't get to this deal. Are you concerned about your portfolio's performance in the near future? JP Morgan, BlackRock, and others are projecting public equity returns of just 3 to 5% over the next 5 years. Analysts at Bank of America urge investors to consider real assets as part of an inflation strategy. So, where are the major players putting their money? Endowments for Yale, Harvard, and other top asset managers are looking into alternative assets. According to Masterworks research, endowments over $1 billion are investing 55% more in alternatives on average. If you're looking for a very interesting asset class that's uncorrelated with the stock market, it's blue chip art. Masterworks.io sells shares in multi-million-dollar paintings by artists like Banksy, Picasso, and Warhol. According to Masterworks, contemporary art has appreciated 14% annually from 1995 to 2020, outperforming other real assets like real estate and gold. I just had the founder, Scott Lynn, on the program again, episode 1232 for an Alternative Assets Roundtable, and he shared some great insights around inflation, appreciation, and more. Go listen to episode 1232. Masterworks.io is a fantastic idea, and they're executing at a super high level. I think it's really genius. So sign up today at Masterworks.io, and if you use the code TWIST, you'll skip their 30,000 person waitlist. See important information at Masterworks.io/disclaimer.